Back in January 2025, a Chinese chatbot nobody had heard of wiped out $300 billion in market value in 48 hours. Nvidia dropped 17% in a single day and recovered almost 9% the very next day. Hundreds of billions moving around because of a chatbot release, and the smartest investors alive can't even agree on what's happening. Some are betting everything this collapses. Others are saying this is the biggest opportunity in human history. They can't both be right. So let's find out which one it is. So before we get into the AI stuff specifically, we need to talk about what a bubble actually is, because this word gets thrown around a lot and most people don't really have a clear picture of what it means. So a bubble is basically when the price of something, whether that's stocks or real estate, gets so disconnected from what that thing is actually worth that it becomes completely untethered from reality. People aren't buying because it makes financial sense anymore. They're buying because everyone else is buying, and they're terrified of missing out. And that works for a while, sometimes a long while, until one day it doesn't, and the whole thing comes crashing down. Now, the comparison everyone keeps making is to the dot-com bubble in 2000. Back then, you could literally add .com to your company name and watch investors throw money at you. Pets.com, Webvan, all these companies burning through cash with absolutely no path to making a profit. And none of that seemed to matter because the story was too exciting. Gartner, one of the biggest research firms in the world, predicted B2B e-commerce would hit $7.29 trillion by 2004. The actual number was somewhere between $2 and $3 trillion. They were off by more than half. The NASDAQ doubled in a single year, peaked in March 2000, and then crashed 83% over the next 2.5 years. Just absolutely devastating for anyone who was in it. And here's why people are nervous right now. The S&P 500's price-to-earnings ratio just hit 40 for the first time since that crash. 30% of the entire S&P 500 is held by just 5 companies, which is the highest concentration we've seen in half a century. Ray Dalio, who runs one of the largest hedge funds on the planet, said the current AI investment levels are very similar to the dot-com bubble. And even Sam Altman, the CEO of OpenAI, came out and said, "Are investors overexcited about AI? My opinion is yes." But here's where it gets genuinely complicated. The dot-com bubble was built almost entirely on companies with zero revenue, zero profits, and honestly, zero real business models. It was built on vibes and promises, and the idea that the internet was going to change everything, so money didn't matter yet. Today's AI leaders are Microsoft, Google, Amazon, Nvidia. These are some of the most profitable companies that have ever existed. Goldman Sachs looked at all of this and said the valuations are backed by robust fundamental strength, not speculation. JP Morgan ran a full diagnostic framework and concluded that AI doesn't meet the classic criteria for a financial bubble. So you've got really smart, really credible people on completely opposite sides of this. And that's exactly what makes it so interesting. Now let's talk about the actual money flowing into AI right now, because until you see these numbers laid out in front of you, it's really hard to grasp how enormous this has gotten. AI spending is expected to hit $2.5 trillion this year alone. That's a 44% increase from last year. And by 2030, AI is projected to account for basically all IT spending on the planet. Nvidia became the first company in history to hit a $4 trillion market cap and then kept going to $5 trillion. That means Nvidia, as a single company, is worth more than the entire economy of every country on Earth, except the United States and China. Microsoft spent $35 billion on AI infrastructure in just 3 months. The 4 biggest tech companies, Microsoft, Google, Amazon, and Meta, are expected to spend a combined $440 billion on AI this year. Goldman Sachs thinks cloud companies alone could spend $500 billion just on AI hardware in 2026. And then there's OpenAI, sitting at the center of all of this, with a web of deals that honestly sounds like it was made up. A $500 billion project called Stargate with SoftBank and Oracle. A separate $300 billion deal also with Oracle. A $100 billion investment from Nvidia. $41 billion from SoftBank in December, which valued OpenAI at $500 billion. A $10 billion compute contract with Cerebras. A $38 billion partnership with AWS. Now here's where things start to look a little bit off. A lot of this money isn't really going anywhere new. It's just going in circles between the same group of companies. And the easiest way to understand this is to think about it like this. Imagine you lend your friend $100, and then your friend uses that exact $100 to buy something from you. On paper, you both made money. You both look profitable. But if you zoom out, nothing actually happened. No real value was created. The money just moved in a loop. That's what's happening here. NVIDIA invests $100 billion into OpenAI, and OpenAI turns around and uses that money to buy NVIDIA chips. Both companies get to report massive revenue growth, but the money is circular. NVIDIA owns 7% of a cloud computing company called CoreWeave, and then buys $6.3 billion worth of CoreWeave's data center capacity. And CoreWeave uses NVIDIA chips to run everything. OpenAI buys billions in chips from AMD and becomes one of AMD's largest shareholders in the process. Morgan Stanley estimates that the debt being used to fund all of this data center construction could exceed $1 trillion by 2028. Oracle is borrowing $100 billion just to fund its deal with OpenAI. And the question that keeps coming up is what happens to Oracle's traditional software business if AI doesn't deliver the returns everyone is expecting? Now, there are people who look at all of this and say it's completely fine. Allison Porter from Janus Henderson, who manages billions of dollars in AI investments, says yes, there's risk in individual companies, but that doesn't mean there's systemic risk to all of AI. These are massive diversified companies making calculated long-term bets, not startups throwing money into the wind. But Jamie Dimon, the CEO of JP Morgan, said something that really puts it in perspective. He said AI is real, but some of the money being invested right now will absolutely be wasted. And he compared it to cars and televisions, technologies that completely transformed the world, but where most of the people who invested early ended up losing money anyway. So the technology succeeds and most investors still lose. Both of those things can be true at the same time. All right, so let's talk about returns, because this is honestly where the whole conversation gets really uncomfortable for the people who are pro-AI right now. In August 2025, MIT released a study that genuinely sent shockwaves through the industry. What they found was that despite somewhere between $30 and $40 billion being invested into generative AI across enterprises, 95% of those organizations were getting zero return on that investment. Not a little return, not a disappointing return, zero. And that number isn't from some obscure research group with an agenda. That's MIT. And the uncomfortable thing is that it's not just regular companies struggling to figure out how to use this technology. The AI companies themselves are hemorrhaging money. OpenAI brought in $20 billion in revenue last year, which sounds incredible until you realize they're burning through $17 billion in cash every single year, and they're nowhere close to being profitable. They are completely dependent on a constant flow of outside investment, and by late 2025, their CFO came out and said they were pivoting to focus on what she called practical adoption, which is really just a polished way of saying they need to figure out how to actually make money. Anthropic is in a similar position. They grew from under $1 billion in revenue in 2023 to somewhere between $5 and $7 billion in 2025, which is genuinely impressive growth, but they're also burning cash at a rapid pace and still completely reliant on outside funding to survive. So if the companies literally building this technology can't turn a profit, the obvious question is, who actually is making money from all of this? NVIDIA. That's pretty much it at this scale. In the third quarter of 2025, NVIDIA reported revenue up 62% to $57 billion and profit up 65% to $31.9 billion. That's not projected revenue or future promises, that's real profit hitting the books right now. And this is where the California Gold Rush comparison becomes really relevant. Back in 1849, the vast majority of miners who rushed to California looking for gold ended up broke. The people who built real lasting wealth were the ones selling the picks and the shovels and the work pants, which is literally how Levi Strauss got started. Right now in the AI boom, NVIDIA is selling the shovels and everyone else is still out there mining and hoping to strike gold. Now, to be fair, there is some contradicting data here. A survey by a research firm called Omdia in October 2025 asked 350 mid to large-sized enterprises about their AI investments, and the majority of them reported very good to extraordinary returns. So there are companies genuinely finding value in this technology. It's not all smoke and mirrors. But there's a real difference between something being useful and something being profitable. AI helps people write faster, code faster, analyze data faster, and that's genuinely valuable. But this saved me some time is very different from this generated measurable revenue that justifies the investment. At Davos in January 2026, Microsoft CEO Satya Nadella said something pretty nervous. He said, for this not to be a bubble, The benefits of AI need to be much more evenly spread beyond just tech companies, which is basically him acknowledging that if AI can't prove its value to the broader economy and not just to the companies building it, they've got a serious problem on their hands. So at this point, the investment world has basically split into two camps. On one side, you've got the bubble believers. Michael Burry, the guy who predicted the 2008 crash, bet $200 million against Nvidia and compared AI right now directly to the dot-com mania. Peter Thiel's fund sold their entire Nvidia stake. Ray Dalio said current AI investment levels are very similar to the dot-com bubble. The Bank of England issued a formal market correction warning, and the IMF backed them up, drawing direct parallels to the dot-com crash. Their argument is that valuations have completely detached from reality. Circular financing is creating artificial demand that looks real on paper, but isn't. And years into this boom, there's still no economy-wide productivity revolution to show for it. On the other side, Jensen Huang stood at Davos and called this the largest infrastructure build-out in human history. He makes an interesting point that if you try to rent an Nvidia GPU right now, it's nearly impossible to find one, and prices keep going up even for older generation chips. Fake demand doesn't create genuine scarcity. Goldman Sachs said valuations are backed by real profit growth. Morgan Stanley called bubble fears misplaced. JP Morgan ran a full diagnostic and said AI doesn't meet classic bubble criteria. And a lot of serious analysts are landing in the middle, saying both things are true simultaneously. Real breakthroughs happening alongside genuinely speculative valuations. Not bubble or boom, but bubble and boom at the same time. And that's honestly the most unsettling conclusion of all. So let's talk about the scenario nobody really wants to think about. What actually happens if this thing pops? Because it's not just numbers on a screen going down. The market concentration we talked about earlier, 30% of the S&P 500 in 5 companies, means when these stocks fall, they don't fall alone. They take everything with them. We're talking potential 40 to 60% drops in AI valuations, which would pull the broader market down 25 to 35%. Your retirement account, pension funds, everyday investors who had nothing to do with AI, all of them take the hit. And then there's the debt sitting underneath all of this. Oracle borrowed $100 billion to fund its OpenAI deal. CoreWeave and other companies built entirely around AI demand are heavily leveraged. When companies start defaulting on that kind of debt, banks get nervous, credit tightens, and it spreads way beyond tech. That's essentially what happened in 2008. The housing market crashed, but the real devastation came from the debt obligations cascading through the entire financial system. But here's the thing most people miss when they panic about bubbles. The technology doesn't disappear. When the dot-com bubble burst, the internet didn't stop existing. Amazon survived. Google was actually founded right after the crash. All the fiber optic cables and infrastructure that got built during the boom stayed in the ground and eventually became the backbone of the modern internet. The same thing would happen here. The data centers already built stay standing. The models already trained keep working. What dies is the fantasy that AGI is right around the corner and that every company needs to spend billions on AI or get left behind. The hype dies. The useful technology survives. So after everything we've looked at, the money, the returns, the technology, the two camps, what actually happens if it bursts? What's the honest answer here? This isn't bubble or boom, it's genuinely both happening at the same time. And that's not a cop-out answer. That's just what the data is showing us. The technology is real. The infrastructure being built is real. The profits at the companies leading this are real. GPU scarcity is real. These aren't dot-com era companies built on promises. These are some of the most profitable businesses that have ever existed, but the valuations have detached from fundamentals. The circular financing is inflating demand artificially. The debt levels are historically dangerous. 95% of companies are seeing zero return on their AI investments. The scaling laws that justified the entire investment thesis are showing real cracks. And history is pretty unambiguous about what this pattern looks like. Railroads transformed the world, and most railroad companies went bankrupt. Electricity reshaped every industry, and most of those companies failed. The internet changed everything, and the NASDAQ still crashed 83%. And took 15 years to fully recover. The technology always wins. The investors usually lose. What's different this time is that the leading companies have real cash reserves, real revenue, real diversified businesses. They're not going bankrupt, but the concentration risk is higher than anything we've seen before, and the debt levels are genuinely unprecedented. So what actually happens next? Nobody knows. And that includes the people running these companies. Sam Altman literally said, "Are investors overexcited about AI? My opinion is yes. Is AI the most important thing in a very long time? My opinion is also yes." Both things true at the same time from the person at the center of all of this. What we do know is that $2.52 trillion is being deployed this year. Some of it will absolutely be wasted. The technology is here to stay, and the next 2 to 3 years are going to tell us which parts of this were real and which parts were just hype. And whatever happens, most people won't see it coming. That's not a pessimistic take. That's just how markets have always worked.